What's up, Gould Miners? Today we welcome Michael Drew to the show. Michael is the CEO of Real Estate Done For You, a full-service real estate investment firm, buy and manage real estate investment properties in the Indianapolis market. Michael's firm buys distressed single-family assets, renovates them, and then sells them to end-user investors, but then takes over the management of that property. It is a fully done-for-you real estate investment solution. And Michael and I start this episode by talking about some of the tax-advantaged strategies that investors can use to deploy their 401k and IRAs into these types of investment opportunities, instead of sticking to the traditional stocks and bonds that most 401ks and IRAs are parked in. Later on in the episode, we dive deep into the macro and micro demand drivers that led him to choose Indianapolis as the hub for his investment business. And finally, we conclude the episode by diving deep into the numbers. We go over the projected returns and what it would look like for an investor who chooses to partner with Real Estate Done For You. Michael's strategy is incredibly unique and fills a gap for aspiring investors who are looking for affordable investment opportunities where their money can work for them inside a reliable and safe real estate investment property. So without further ado, everyone, let's welcome to the show, Michael Drew.
The Gould Mine podcast.
Michael, welcome to the Gould Mine.
I love it, Danny. I'm glad to be here, my man.
Yeah, no, this is exciting, and you know, we were chatting a little bit before this. So it sounds like we got a few things in common, you know, including our love for CrossFit. I will say,
absolutely.
No, that's awesome. So, hey, you've done quite a few things now in your investment journey, but the one thing that kind of stuck out here is, and I'm going to kind of tackle this head on right away, is talking about, you know, creating tax efficiencies in your real estate investment portfolio, right? And so, it's my favorite subject, Michael, how to you know, keep Uncle Sam out of my piggy bank. Okay. So let's just dive right into that. Like, let's talk about some of the efficiencies that you've created before, that you've kind of helped create for investors.
Well, a couple different things. Why? Well, you know why that's important, but it just like anybody else, we're talking about some sports. I like to reverse engineer the goal you're looking for. You want a great relationship? Take the girl or a guy on some dates, right? You want a great relationship with your kids? Same thing. What's the goal? What's the point? So, hey, your goal is, you know, 25 grand a month or 50 grand a month or 10 grand a month when you retire, tax free. Okay. Or whatever so if that's the goal, then in your 30s and 40s, act like it. Just, you know, perfectly. So on the leverage basis, let's say you're getting a mortgage, right? Well, single family real estate can be depreciated on a 27.5-year schedule, right? So we've got our depreciation schedule fights our positive cash flow, and that evens it out. A lot of my W-2 clients really like that. Okay, you probably go over that, you know, ad nauseum. Here's one of the things that I did that was a little bit edgy in my 30s and 40s is I went ahead and recharacterized, or I basically turned my old 401k after I left a company, which then became an IRA. You can pay taxes on that and make it and turn it into a Roth, right? And then through that Roth, you can either buy real estate free and clear, or you can get non-recourse loans and acquire real estate through a Roth. You know, so there's a bunch of different ways that you can either what's called hypothecate or leverage some of your investment assets. As a property management company, I noticed that we might be sending one of our clients, you know, $4 grand or $5 grand a month in his LLC or his social security number. And then we're sending his IRA or his retirement account another $4 grand. And so that's actually why about 6-7 years ago, myself and two other guys, we built up our own self-directed IRA company. And because I just really enjoy talking about those strategies, my mentor he's that old former, you know, presidential candidate, I forget his name, had like 55 million in his Roth. So we're definitely not at that level. But, you know, if you could retire, why not have most of your assets in a tax-free or at least tax-advantaged vehicle? I think that's a smart way to do it.
Yeah, 100%. And so what kind of investments, so when you make that, I think a lot of people might be just unaware of the nuances or the differences here, right? Because when you talk about a traditional IRA, maybe a 401k, these are usually managed, right? They're not self-directed, right? So what is the differences? What are the key differences between a traditional 401k or retirement, like an IRA, and then like a self-directed IRA?
Sure. So what you might think of as a traditional 401k, start there, which is what most people are, accustomed to, would be something that's employer-based that they can, the employer can contribute to, right? And then it's up to you it's up to you in the charter of that account to see if you want to characterize your contributions as pre or post tax. So it's up to your company. You could have either a 401k Roth, or you could have a traditional, which is a pre-tax 401k, right? Okay, that's one thing. So the only way to really have a 401k is with a company. Okay, so that when you leave the company, you have a choice. You can either, if you get hired by company A and then hired at company B, although yes, you could roll your 401k over to the new company. They would be delighted to see your money, right? Or what you could do is you could have that just not distributed, really recharacterized, to use the proper terms. You don't want it distributed into your 59 and a half. Okay. Sure. I'm no longer working at, whatever company it is, Tesla. I'm going to start my own electric car company, and I'm going to recharacterize that as my own IRA. Now, if you put it with, Charles Schwab, for example, that recently bought TD Ameritrade, they are mainly involved in equities. So even though, yes, technically all IRAs are air quotes self-directed, is a Schwab or a Shearson Lehman or a Smith Barney, they will only allow you to buy equities, mutual funds, ETFs, things like that. Whereas using the nomenclature self-directed IRA company, like our company, a specialized IRA trust company, or there's a few of them out there, we will allow you to do much of anything. We'll allow you to do whatever's legal, right? Buy real estate, loan money to projects, loan money to, flippers. You can do a lot in a self-directed IRA. But however, for example, my account is we have to then pay property taxes twice a year, and we have to write State Farm a check once a year if we own an asset in our IRA free and clear, right? Because we don't have a mortgage. I usually don't have a mortgage on that. So it is that company that gives you the little bit more dexterity to do some of those, more fun things. My wife, for example, owns a property in her Roth. She's got, so what happens is her property management company then direct deposits her rent money into her Roth every month. So I want you to think of that there you go. I own BP Oil, let's just say, right? And BP Oil has quarterly dividends. Well, if it's owned in my IRA gets the quarterly dividends. Yeah, good for me. You see, as a line item on your equity form. Well, my wife owns a property in her IRA, so that gets monthly dividends. So then the property management company direct deposits like clockwork every single month. So what happens is that out of those funds, she goes ahead and pays her property taxes and insurance. She's not 59 and a half yet, so she doesn't use that money for groceries or anything like that yet. Really, what I have some of my investors do, they say, hey, I've got, 6 figures in my IRA and I don't want to lose any of it. They'll buy 2 or 3 homes. And before you know it, they call me up in a year or two and they say, hey, I got enough money to buy another one. Rock and roll. Let's go. Let's keep rolling it. If we get 10 homes in there at $1,500 to $2,000 a month, now we're moving the needle a little bit. So now that money will come to you if you so choose when you retire, 59 and a half, whatever it may be. So there's a lot of dexterity that people don't know about in those accounts.
Yeah. And I think we're just kind of scratching the tip of the iceberg here, for Michael. Sure. And I want to kind of go deep with you here. But before we do that, why don't we catch the audience up on, for those that don't really know, like who you are, what you do. Sure. Why don't you, like, at a high level, because we went right. We didn't spend a lot of time on the foo-foo stuff. So let's take a step back here and why don't you, where did you kind of like first get your start, and what is it that you do today to help investors
absolutely
with their real estate needs?
Sure. So again, my name is Michael Drew. The name of my company is called realestatedoneforyou.com. So it's real estate done, the number 4 and the letter u.com. All right. And really that was born from a concept that happened to me when, guys are guys and I play competitive pickleball. So we always like to razz each other and tease each other and, whatever. And my buddy, when I bought my dream home, he literally what happened this well over 20 years ago. He's like, oh, good for you. You bought one home. And he's like, I never made as much money as you, and I own 20 rentals. And I'm like, well, my rental is expensive. My primary is expensive because we live there. And you've got 20 people sending you money every month? I don't really understand this, but I need to start. Okay. So literally it was started out of my, the male fragile ego that said, I want to catch up with my buddy Jeff.
Yeah.
And so, and unfortunately what happened when I was younger, when I was 31, my dad passed away. And then it was that, like, I'm the more financially astute, sibling, if you will. So one of the last words I said to my dad, which is I always thought a son should say to their dad, is these words: I will take care of mom, which I didn't know what that meant, but that seems like something a son should say to a dad who's on his way to chemo.
Yeah.
Well, when he came to pass, I said, well, my mom doesn't have the emotional bandwidth to handle the stock market, ups and downs and this and that. So what we did is we rolled over my dad's retirement account to an IRA. We bought real estate, and the rent was enough to replace his income, plus some other investments she had. She never had to worry about income the rest of her life. And when I told that story at a financial thing in California, in Southern California, not up by you, one lady raised her hand and said, can I be your mom? And I said, well, sure. And so that was about 1,100 houses ago, or just over $105 million of homes ago, where I've bought homes, I've rehabbed them and rented them out and given them to investors and just paid them all the rent. So whether it's my mom or whether it's my top client, is about half my clients seem to be in California or the coast. Ventura, California, he owns 88 homes. We've been sending money to investors for years and years and years now. We do all the grunt work, if you will, and we just send you a check every month. Mailbox money. Don't have to worry about a thing. Just buy the asset and we'll take care of all the details for you. So it's called real estate done for you. And it worked for me, and it's worked for investors over the years. We mainly, since I went to school, if you will, by working for Robert Kiyosaki of Rich Dad Seminars, he really loved the Midwest. And so we said, hey, I don't want to do everything everywhere. I want to target one city. So we targeted Indianapolis, which just kept coming up on top 5 cities every time I did my research. And that's where our homes are based. It's like the 14th largest city, well over 1 million people. And that's what we've done. So we've been doing it for years, and I truly enjoy it, because not only have we, my kid, I have 2 kids own properties. They're 21, 23, and they have their first rentals each of them. It's great.
That's awesome.
So yeah, it's just been a joy. Also from a income standpoint, it's been great, but we're all grown-ups now. Anything that has happened wrong, whether it's a vacancy or something crazy, whatever bad happens has never been that bad. Meaning, like, we've not ever lost a lot of money on anything. You go into a scenario knowing that you have danger, right? When you take your money from a savings account into whatever it may be, a car or a house or a syndication, you could lose money, right? It's possible. But anything that we've ever done has been real low law, a vacancy we can handle, right? A water heater we can handle. And it's been a great investment over the years.
So how does that work exactly, right? So your company, it sounds like you have a couple of different branches here, like, as a part of the greater umbrella. So it sounds like you've got a renovation, like basically like a flipping company, if you will, right? And they handle the value adds, so to speak, right? And then you've probably got some sort of property management company involved too. So why don't you walk me through the semantics of all of that? Because it sounds like you got a lot of moving parts.
We do. The whole, my background is more entrepreneurial. So really it's like if you and I, Danny, were to sit down and say, let's go start an Uber business in Miami or the Bay Area or wherever it may be, we would research what's the highest revenue per Uber. Okay. And we would never buy a Lamborghini or BMW. Right? Because they're expensive to maintain, right? I mean, they may be your eye. We might be a dream car. We never buy Bugatti or Mercedes. It's just too expensive.
Yeah.
So what we would do is we'd say, who's the one making the most money, right? And the most money is on the 2 vehicles, Toyota Camry, Toyota Prius, or a minivan, because they can get the XLC. So that's what I did, is I went to a city and I found out, okay, my investors ultimately want to replace their 6-figure incomes, most of them. Okay. Yep. So therefore, where do I buy? What do I buy? How do I rehab? So we get the best bang for the buck. Okay. So to answer your question, we own the acquisition company. The acquisition company buys anywhere between 70 to 200 properties a year. Okay.
Got it.
From the ugly houses to the courthouse steps to the wholesalers to whatever it may be. We buy those houses. And if you don't know, we never look through the MLS. If someone's looking to do this through the MLS, it's already been picked over by, 10 guys like me. We never look give me a break. If it's made it to the MLS, we've already passed it over, right? So we buy in these, we have about 7 acquisition sources and we have to buy in cash. There's no way you can buy unless you're buying in cash. Second, we do own our own rehab company. And through the years when times have been good and COVID times, whatever it may be, we've kept our staff employed. So they really we have a lot of loyalty in our staff. Okay. And then we say, well, this all works because the tenant pays and hopefully pays on time, right? So then we also own the management company. And why that's worked so well, because what we might think is a good rehab, my management company would come back to me and say, you know what, this isn't working so well. Whether it's flooring or kitchen or quality, any quality we do, whatever it may be. Perfect example. I thought I was God's gift to rehab when I bought a semi truck full of chocolate brown commercial grade carpet. All right. And everyone then about 2 years later, the property management company says, no one wants to live in someone else's carpet. So every time we get a new tenant, we turn it over. So then we went to ceramics or luxury vinyl plank and, from plumbing to all of our kitchen counters to, we are a kind of a professional rehab company. All the SKUs that we rehab are the same. The toilets are the same. The furnaces are the same unless it's a bigger, smaller house. The exterior condensers are very similar, again, depending on square footage. So we're kind of production grade. So literally the maintenance truck that drives around and goes to one of my houses, we get a call that the water heater's having trouble or the incinerator underneath the sink is all stuffed up. We've got one on the truck. If we can't fix it, we'll put a new one in. So we're all dialed in. It's the toilets are the same, the wax rooms are the same in all the houses, so we're dialed in so that we can scale and get the investor a good experience, right? Oh. So not only the property management, and then that's, so how do I make money? I buy low and sell high, but I don't need to make a ton of money because we also have the property management. So then we make a little residual income off that, charge the guys a couple dollars and then go from there. And also about half my business is repeater referral business. I'm still that old school guy. Yes, you can text me for sure, but I still like to get on the phone and jump on the phone with people. And someone says, hey, I've got this going on. Or, hey, like me, when I first had a kid, I didn't put money into a 529. I put some money into a 529, but I said, I'm just going to buy a house. Buy a house, have the tenant pay it off so that when the kid is 18 or 20, when he ever wants to go to college, just sell the house. Should have well over 100 grand. And pay for the kids' college or 100, 200, you know what I mean? These are things that I thought of. And so I kind of reverse engineered everything in the city with the prices and whatever to perform for the investors. Same thing. We can't put, as they say, air quotes, lipstick on a pig because an investor doesn't want to buy HVACs and water heaters. So we put the roofs and the HVAC and the water heaters and all the plumbing and the kitchens and the baths all in for the investor. So they have very, very little capital expenditure. So we have the soup to nuts, real estate done for you. And Ed has worked out very, very well. Yeah.
So so it seems like you've got a lot of different facets to this process. Now, let's talk about the investors, right? So the investors come to you, you own a company, like you're an IRA custodian, I'm assuming, or something like that.
So we also, that's another one of my companies, but absolutely. So if someone says you can acquire either cash, you can acquire on a mortgage, or if you've got money in an IRA, you can acquire in an IRA. Most people, like I have a gentleman, 35 years old, he was making solid 6 figures. And he's like, in my industry, we physically move. He was in, I think, mobile cellular security or some sort of mobile security thing. And he's kept getting job offers every 2 years. He's like, it's too expensive to buy around here. I'm just renting, but he was making plenty of money. And he says, but I've got to put this money somewhere. I already have a nice car. I can't go to Fiji with my friends all the time. So he says, he literally will buy a house every year, or every other year. Okay. So what happens is they will acquire not with cash or an IRA because he's only 35. He will use the average price of my homes are, 150 grand, 200 grand, right in that area.
Sure.
In the Midwest.
Sure.
So at 150 grand, he'll put 20% down, 30%, 30 grand down, closing costs, and he owns all. So that's as simple as it is.
Wow. Okay. Mm-hmm. That's a really interesting concept. Now, where did you come up with this concept? Because it seems, fairly novel. I mean, I don't know that I've heard of anyone else doing it quite like this. So I'm curious kind of like how you came up with this idea, what inspired it?
Well, here's what I think. There was a guy that said this to me one time. I'm not the smartest guy in the block. I'll just outwork you. And he said this. He said, good judgment comes from experience, and experience comes from bad judgment. Meaning you follow. I mean, you learn virtually nothing by succeeding. You know, like, I do. I play a lot of pickleball, and I'm like, we just won the semifinals. I'm sorry, we just won the quarterfinals, and we're just getting lit up on the semifinals. We're just getting crushed. So we talk and we go, what worked yesterday is not working today. What we got to change, Yep. So really what happened, why I developed it like this, is I found a guy in Indianapolis, and he was an executive at UPS. Okay. If you don't know, UPS was a private company that then went public. And anybody had that private shares, when they went public, they got paid, right? And I always, I joke around. I say some people were silly and they bought, cars, and other people were smart. They bought real estate with it, right? And he basically screwed up. He bought 20 houses, and he just didn't have a system in place. He had no management in place, and all of his weekends were toast. He said, I had no system, Michael. He said, I had money and I had good credit, but I had no system. And so, do you remember, I've quoted a couple of times, I always forget. I want to say Atomic Habits, or maybe it's James Clear. He says, you don't rise to your goals, you fall to your systems, right?
Yep.
You've heard that.
Yep.
So I said, all right, well, we need systems in place. So I really learned from a bunch of failure. Tom's failure, one of my mentors, a variety of other people. And that's really what drove me to this. And I said, all right, how do I do this? And then as I got older, okay, I was born and raised in Chicago. As I got older, I said, I don't like traffic. Like, I love the city, but I don't like sitting in traffic for 2 hours a day or an hour a day. Yeah. This is stupid. I don't enjoy it. I enjoy working out. I enjoy my family. I love my kids. So I'm like, I gotta make this all so it works, for my investors. And I want to do it in a city that's not like California is very tenant friendly. Chicago is very tenant friendly. I have a place with my wife in Florida, but because of, weather, insurance went up 180% in the last 18 months. So you've got to play defense. You got to figure this out. And every time I did that over the years, I've invested in several different states. It always brought me back to these base hits, easy peasy, not super sexy homes in the Midwest. And that's why I did it here in Indianapolis, because it just makes perfect sense, right? Over 50% of my city rents, and I'm able to find tenants. I'm able to find the homes and make it work for my investors,
Macro level, Indianapolis, what are the demand drivers there that, have made it a good market for this strategy? So we could start there, and then we'll go into the micro. But from a macro level, Indianapolis, like what, because I don't know much about the market, right?
No worries.
What is it about that market that kind of, creates a stable environment for you?
Sure. So when you think of rental real estate, the number one thing that you always think of is jobs. Everyone knows that. Okay. Yep. Those are my clients. Okay. So you might, I grew up in a small town in northwest suburbs in Illinois, 15,000 people. I know every street. Not a great, I could say go by these houses, but not a great area because there's not a lot of jobs nearby. Okay. So they always say, you live where you want, but invest where it makes sense. So the number one reason that you invest in a city is because it's got a healthy job market and job growth. Now, the derivative right underneath there is, where are the jobs? So in Chicago, where I grew up, the jobs were maybe in the city, or it would just take an hour and a half to get to the jobs. Okay, well, that's hard too, right? Because, they're going to move out to the suburbs. Or is my multi-unit friends, okay? In Chicago, people lived in multi-units, okay? But somebody like me who has 4 kids, we're not going to live in a multi-unit. I haven't lived in a multi-unit unless I don't want to hear someone else's music or smell their marijuana in years.
Yeah.
Right. So all of us, so therefore we want the number one reasons why people don't do the math on this in my single family world is that turns between tenants can be very expensive if you don't account for that. Right. So in my world, families live in houses. The last time I lived in a multi-unit was when I was single, and I had a blast, but I didn't bring my kid back to an apartment. That made no sense. When I could go rent a house and have a yard, teach them how to catch, right? So then I'm like, all right, so now I got families and I want good jobs, okay? So the next thing that you want to think of is what kind of job. So not only is the distance to the job, but what kind of jobs? Well, that was the failure that my friends did in Detroit. During one of the recessions in Detroit in the last 20 years, there was arguably, they would report about 9 to 10% unemployment, but you should also include underemployment in that, meaning the $100,000 or $200,000 executive takes a job for $65,000 to put food on the table, right? So during recessions, they were faced with a larger unemployment. So I'm like, well, that's no good. So again, that drove me to these multi-employer-based areas like in Indianapolis. Our competitors would include like a Columbus, Ohio, or Memphis to a different degree, Kansas City to a different degree as well. So number one, jobs, location, and different demographics. Different, employer-based, And then the tapping into that micro right there that you mentioned to play a little defense is the following: is you want a landlord-friendly state instead of a tenant-friendly state. Now, those terms are thrown around. What the heck does that mean? Is there a book definition? It's kind of like, what's an A-class property? What's a B-class property? Where is it on the wall? Where does my property fit on that graph, right? And when I speak in California's Los Angeles real estate investment conferences, it's $10,000 to get somebody to, get out of a property. It's crazy what they all do.
It's crazy.
Right? Or Florida, it's not too dissimilar. Chicago, same thing. So whereas in our cost in Indianapolis, rent is due on the 1st, late on the 5th, you're evicted on the 16th. It's $336 for evictions, and they're out in 30 days. So, okay, that's what it is. And here's what the judge says. The judge says, we're in what's called a no pay, no stay state. So he's like, they do a big joke. They're like, we don't care if your dog's sick, you're sick, or your car needs an oil change or an engine. Did you pay rent? No. Well, here's the excuse, right? Like, whatever it may be, I appreciate your excuse, but I'm a business owner, right? And so I'm able to get them out just in case they're a non-payer. So anyway, so those are just some of the first couple areas. So far, this crosses out a lot of the cities, though. Remember, even if I can't even be in an HOA, I can't have one of my buildings have an HOA because all that does is cannibalize my investor's rate of return, right? Yep. I mean, my condo in Florida is in an HOA, but I live there. But I can't have an investor in an HOA because that's wasted money, right? So you keep thinking along these lines and you're like, wow, I don't want to be in California. I love Florida. The weather's so much better, but okay, well, property taxes are high in Texas. Then you think of your tax-free states, right? So we got Nevada, we've got Texas, we've got Florida, right? No state income tax. And what do they make it up on? Property tax, right? Okay. So you keep crossing all these out and you're like, what is the most efficient way for me to do this? As it keeps leading you back to the Midwest areas. You're getting excited, Danny. I can see. We're gonna check your credit afterwards and see if you qualify. You never know. I don't know.
Let's make it happen, buddy. Let's make it happen. So, no, I mean, look, and there's a lot of ways that I could take this.
Right.
At a micro level, at a community level, what are the things? Because I want to round this out, and then we can go to the next subject. But on a micro level, what are we looking for? Like at a community level, neighborhood level, to ensure like, hey, this is the right community to invest in versus other neighborhoods. Like, are there certain metrics and things that you're paying attention to?
Absolutely.
At a local level? Okay.
Yes. So neighborhoods, local level, what to pay attention to. So we go to performance. So we really have 2, 3, and 4 bedroom homes to choose from. We also want them to stay. So the whole goal of this is to have them stay in the home. Therefore, we need the homes to be easy and cheap to operate and easy and cheap to heat and cool, right? So you and I might want to live in a 35 or 6,000 square foot house, right? Expensive to heat and cool, right? Expensive to maintain. So that brings us all the way down to our 1,000 to 1,500 square foot homes. There are 3 bedroom homes that are ideally brick on slab, right? A slab foundation. And that means your HVAC and your water heaters are easily accessible. Everything it's really easy to maintain, little bulletproof homes. Now, the 3 main home builders in the Midwest that built these types of homes actually mainly built them with 1 bath. Don't whine and cry about it. It's the way they built them. Okay. So the 3 bedroom, 1 bath, 1 car garage, And a lot of our, there was a big boom in the 80s that this company that came around and they converted everyone's garage to a 4th bedroom. And they did it really, really well. So a lot of our homes are 3 and 4 bedroom, bath and a half, 1,000, 1,200, 1,500 square feet. They sell for about right now, 150 grand, give or take. Right. And those that's our Toyota Camry. It rents like hotcakes. And the neighborhood, since we've been doing this 15 years, if you tell me a street and the number on the street, a 3900 block of XYZ street, I know that street. I know what that house is going to look like, or it's one or two derivatives of what I know. And so I know what it'll rent for. I know what we can buy it for. Now I will say this is what we used to rehab for $25,000 or $30,000 is now up to $45,000 to $50,000 at least.
Right.
Everything's gotten more expensive, but I don't want my investors to say, well, I want a new house with a 50-year-old roof. That's not it. That's not in their best interest. Right. So we still do the same level of scope of work on these homes. Okay. Now those neighborhoods are mainly owner-occupied neighborhoods. Okay. Now, granted, we have a good majority of the city that rents, but you drive down any of our cities, our streets, if you will, and I got to tell you, there's from Halloween decorations to Christmas decorations to the level of cars that you might imagine, or all of a sudden you'll find, someone spent $10,000, $20,000 on their front yard. We've got fences going up. We've got outdoor kitchens going in. I mean, it's just crazy. And it's, imagine this. I've got like one of my tenants. He's a truck driver, makes about 85 grand a year. And their mom passed away. So he's living with his dad right now. His dad's got a military pension and a Social Security, I think. So the household makes well over 100 grand a year and the rent's 1,500. And he says, can I put a fence in the backyard? Yeah, sure. But you know what I mean? I mean, these people make these houses their homes. And on average, they're staying well over 3-4 years. And we work to have them stay longer. So we are in the hardcore B2B plus market. Okay. Yep. And that's where we have mature trees. We have sidewalks. We have, it's safe at night. And, so any investor can come to town and drive there. Investors say, hey, I picked up these 4 properties last year and I'm going to come in the spring when it's warm and I'm going to drive them with you. I said, jump in the truck, come on out. I'll buy you a meal. Let's do the Chamber of Commerce tour. And you're going to be happy with what you bought. Because everything starts on our portfolio first. Yep. So Danny, before you buy your first home with me, it's probably going to be next month, is that I've already owned the home. It's already in my name or my LLC, right? So and I don't know if you're ready next month or in 6 months. And I don't care. It's good real estate. I own it. So they all start on our portfolio first.
Yeah. Do you retain any of the properties for yourself? Like, are you burying any of these? Okay.
Absolutely.
Gotcha. So
we call it back pocket, so we'll back pocket this, that, the other, if you will. Our goal is the same as our investors. Okay. In fact, after, we kind of relaunched our property management company because we realized that much of our staff is comfortable. They're happy living at home, right? At least working from home, I should say. So I say, hey, we take our back pocket properties, we kind of take them off the website, right? And then myself, my wife, and we all kind of say, hey, these are good doors. Let's sit on these. My sister does the same thing, and it's good.
Got it.
And it's kind of exciting to do it that way too. We also are, we acquire in very creative ways sometimes that are a little not outlandish, but very creative, let's say. Okay. So it's fun. It's after you do it for a while, it's kind of a game, if you will. How do I get to that level and we all have so much money. We have 100 grand or we have 100 million. We all have so much money, right? And eventually you run out of it, whether you're Elon Musk buying Twitter or you're building electric cars. He's got more money than you and I put together probably, or whatever. We got to make it work as efficiently as possible. And it's a little bit of a game to make it happen and do it as tax efficiently as possible, right?
Well, to me, this seems like a really interesting way to do, to flip properties and like keep them working for you in a variety of different ways. Let's be honest, right? The majority of people out there that rehab homes for a living, we'll put air quotes, the majority of them, and I'm not trying to villainize them, right? But like they're usually undercutting the seller and cutting corners on the rehab.
They're not incented to do otherwise.
Exactly. But your model incentivizes you to not cut corners. That's Correct. What I'm hearing.
Right.
Which is a very interesting way.
I see a lot of 1031 exchanges. They'll make their money on the coasts or in Florida or Illinois or California. And they're like, hey, this is appreciated to the point where I'm making a very small amount on $3 million of real estate or whatever it may be, $1 million real. So they will sell that appreciated California real estate and they will 1031 exchange. Like the last guy that I just closed today with 7 houses with me. Okay.
Jeez. Free and clear probably too, huh?
And he bought 7 houses, all rehabbed, all done, inspections punched out, all done.
Oh my God.
He says, all I gave me is his routing number and account number for rent next month. Okay.
That's incredible.
Now, he was referred by his brother that bought 3 and had a great experience.
Yeah.
Right. And and it reminds me of if you go to a restaurant, you order a steak done medium, right? And it comes out too rare or too well done, and you're not happy, and the waitress or the purveyor or the, whoever it is comes by and you're like, this is fine, but I ordered it medium and this is not whatever. And the guy takes care of you, right?
Yep.
You don't expect him to buy you a steak. Many times they do, but you don't need that. I just want a good meal. You have cost of your goods sold. You have food cost. So that every now and again, I might put in a water heater and it breaks after a year. Well, I've got a warranty on it, but you bought a house for me. I'll deal with the warranty. I'll put in a new one and I'll go chase the guy on the warranty. You don't worry about it. I got it. That's the type of thing you do for people. I got to get that tenant happy anyway, because I'm charging top market rate. Right. So I'll just take one from my storage unit, put it in, and then I'll go beat up the manufacturer to go get my money out. That's the type of thing you got to do. And it works out real easy because the tenant's happy. The investor doesn't know any different and go from there.
That's really interesting, man. This is super novel. I haven't heard, I'm sure someone else is doing this.
I'm the only one in the country. That's a joke.
Yeah. I'm sure there's other, but I think you're the first one that I've heard of doing something like this, which is interesting. But I was like, I'm sure other people are doing it. But this is fascinating. One thing that popped into my head as you were talking is, and of course I'm gonna blank the second that I'm trying to ask the question, because that's how it works. It's like I had the question, it's right here, and then it just doesn't come out. I'm sure it'll come up, and I'll ask you at some point later on in the conversation.
No problem. I did want to say something to get a little the second level on the properties, on the cities. Yeah. Okay, the top level is your jobs. Okay,
sure,
and then landlord friendliness, and then what you do. You can there's 5 levels essentially. So number 1 is the city, the jobs. Okay. All right. Then it's the industries on the jobs. Okay. Some of the same things. Then the next, landlord friendliness. The next is your insurance costs. Okay. So again, in the Midwest, it's about $700 a year to insure a property. We use State Farm. Okay. You can go to whoever you want, but that's about right. Okay. And that's where the Florida doesn't work out so well. That's just the latest example because they've just been getting their tails handed to them. Right. Okay. Next is your property taxes. Okay.
Yep.
You got to go to somewhere. All right. Ours is capped out at 2% of the appraised value. Okay. They're very reasonable. We have performers on our website. So those are in line. Okay.
Yep.
Right. Right. And then finally is what happens. This is a little bit deeper, but if you've been around long enough, there will be ups and downs of the economy. Right. Like one of my mentors who wrote books, Jim Rohn, he says, what a great time for seasons to have spring come after winter. Meaning when it's cold, everything's gray and, cruddy out, right? Then comes spring. So during recessionary times, people go back to school. I got fired, got let go. I heard this, they pink slipped my department. I haven't heard that before. All right. Or my mom in the Midwest, she got, downsized, right? So they move in or they consolidate their homes, right? And then they go back to school. We have over 20 universities nearby. And that's what we've known is that these universities are like little microeconomies. People still go to school all the time. They get loans and go to school, right? Finally, it's the county seat, meaning the state capital. Okay. So there's always government, city, jobs, maybe jails, maybe things that happen in the county seat. There's employment in the county seat. Okay. So we're in the capital city. We've got several universities nearby. We got low insurance, we got low property tax, we got landlord friendly. And then lastly, within 700 miles of Indianapolis is 2/3 of the American population. My California investors are like, I don't really know much past Colorado. Oh, I'm kidding.
Yeah.
So in Indianapolis, if you get up early enough, you can go to Indianapolis for breakfast and go to New York for dinner. Okay.
Yep.
or you can get up in Indy in the morning and go to Chicago for lunch, 3 hours. So it's not that far. I'm driving from, to Detroit, to Atlanta, Nashville. You can get it. Now you got to pack a lunch. At least you're going to go to Florida, but it's still within a very reasonable period of time. And I was embarrassed on how much it's during the holiday season right now. I'm embarrassed on how much I used Amazon. If I found something on somebody's website, I'd just be like, Amazon can deliver to me tomorrow and it's free. Why would I go to a store? That's how it's horrible how many boxes are at my house right now, but from batteries to anything else. Like, why would you go to a store? I need AAA batteries. Just, they'll be at my door for $5 tomorrow, So anyway, is that a lot of logistics companies are based in these areas. So warehouse jobs, logistics jobs, right? Eli Lilly is based here. It's the second headquarters behind the Bay Area for Salesforce.com. Yeah. So there's a larger, plenty of employers nearby, and it's gone very, very well. So if you add all that up, you don't get a lot of cities that pass the sniff test. Okay.
Yeah. No, that's actually a really detailed. I thank you for all of that, because that's a super detailed overview of like the things that you look for in a market. And I mean, I think if your primary objective is stable cash flow, I think all of those all of those principles are very solid principles to kind of like abide by. And it makes sense. I mean, look, like I said, I don't know too much about Indianapolis. But I do know like that it is like, I have heard of a lot of people like touting that market as like a really stable market. And so that makes a lot of sense. I did remember my question, by the way. So I had two. The first one is, what is the average? And of course there's highs and lows and stuff, but what's the average NOI, after on per door on a monthly basis?
Sure. Our cap rates is what I'm used to kind of quoting, or your capitalization rates are right at about 8 to 9%.
8 to 9%. Okay. Yeah. Gotcha. 8 to 9% cap rate, which is pretty good. Okay. Gotcha. And so like for that guy, for example, the guy that's bringing you 30 grand a year, and he's going to buy a property, leverage 80% of it. What is the typical cash flows after debt service on an asset like that?
Sure. Yeah. So let's just say, for example, we buy a $150,000 asset. Okay. Yep. And our down payment's about 30 grand.
Yep.
Okay. Interest rates are a little bit high right now. Okay. But they always say, what? Don't wait to buy real estate and wait. Okay. Right.
Yes, sir.
And so, even on a 30-year mortgage, you're going to expect about $200 to $300, let's just say $250, $300 in positive cash flow, all factors included.
Per month.
Per month, right? So let's just say we're at 250. Okay, that means we're making about $3 grand a year.
Yep,
sounds about right.
Which is 10% on your investment.
Okay, now true.
Cash flows.
Now, even though you were touting our stable market, we used to, Robert Kiyosaki says you plan on cash flow and you hope for appreciation. That's what he says. Okay, our appreciation has been, these sleepy little markets have been creeping up. All right, so basically we're gonna be at or beat inflation 4, 5, 6%. Okay.
Yep.
So in the back of your mind, think about this. We've got an asset that we're making 10% on. Number one. Number two is our $150,000 asset is appreciated at, let's just call it 5% for my easy math. Okay.
Yep.
So essentially, although this is a soft benefit, we've got about, call it $7,500 a year in appreciation. It's not a hard benefit, more of a soft benefit, right?
Yeah.
Right? And on top of that is we've got, if we put it on our balance sheet, okay, we've got an asset at $150,000, and let's say we have a $120,000 mortgage, which is the 30 grand off the 150.
Yep.
Well, our monthly payments are going to actually, although very slight, are going to decrease the debt service, right?
Of course.
Yep. Very small. And then on top of that is, remember, we're buying an asset that has tax advantages.
Of course.
So when you add up all those different factors, from just the cash flow, the appreciation, principal pay down, and the depreciation benefits, we're getting, in the teens, if not knocking. Interest rates are a little high right now, but we're not knocking quite on 20%, but we're knocking on high teens and on an internal rate of return if you include some of the softer benefits.
Yep. So, no, of course. And when you just look at the cash flows, that's not telling the whole story, right? Because any sort of institutional asset or like commercial real estate deals, syndication, whatever, like we're always looking at the IRR and obviously those IRRs take into consideration, well, not the depreciation benefits, but certainly the exit, right? So a lot of these deals live and die by
that exit, buddy.
By the sale. Yeah, exactly.
Also,
or the refi. Yeah.
And you're better at that stuff by far. But I also want to think of, I'm an old, I raced motorcycles just south of you in Monterey, California. You ever been to Monterey, California?
Plenty of times. Great city.
Times. So that was Laguna Seca. Been out there racing a few times. Have you ever been to that track?
Nice.
It's not a scary track, but you gotta pay attention on that track. Anyway, we always think, how do I get out every time I get in a situation? All right. I'm going to pass this guy. I'm going to do this. I'm going to do this investment. How do I get out? And you got to be comfortable with that. So my friends who do multi-units are super successful. Some of them have exits like you just articulated, but in a single family investment, it's really not that hard because my leases say that if the investor sells the house, it's a 60-day notice. We put mulch in the yard and we sell it for you. That's it. So it's not, and and keep in mind, like, I kind of tease with our multifamily guys. I tease a little bit because when you exit a multifamily, you're exiting usually to a professional, meaning they're going to evaluate your asset. They're going to evaluate your CapEx. They're going to evaluate any cost seg they can do. They're going to evaluate all these different factors. They're a mature, sophisticated investor, right?
You would think. You would hope.
Like yourself, my man. But when you exit a home, you're and you say, I want to get top dollar. I'm going to say, let's wrap it out. We're going to list it in the springtime. Why? Because that's when the best time to sell is in our market, right?
Yep.
And I planted a tree and the tree's pink and I'm going to make 10 grand off that tree for you because it's pink. Yeah. And whoever buys a house is going to want a pink tree. You never know. But the bottom line is you're dealing with, not to be rude, a little bit less sophisticated investor when you sell retail versus a 100-unit apartment building, right?
Yeah. And it's interesting, right? Because I teeter back and forth on this. I teeter back and forth on how emotional institutional investors are or people who I guess are more, have more of a business approach because I used to think it was a very simple cut and dry, residential, highly emotional. By the way, I used to sell real estate. So I used to, I didn't like the tone of that, Michael. So I used to sell. So I understand the psychology and the emotion, behind buying residential real estate. Yeah. And I used to think, because those commercial guys, they don't care. Right. Let me tell you something, man. I've seen some people make some really stupid decisions and it's still an emotional game, but to your point, it's more numbers driven, right? It's a more numbers driven approach. Right. And that numbers driven approach, definitely creates a floor, but it also kind of like creates a ceiling. And I think in the residential space, there's higher ceilings, especially on the appreciation potential. Depending on the timing of the cycle, right? But I think right now, especially, like you're not doing anything crazy in the commercial space, right? And probably not in the residential space, but
right. But you think of it is, it was so interesting because although cash flow is not as high as it used to be last year, for example, because interest rates. My buddy who's been doing this longer than me. He says, "Are you confused?" I go, "What do you mean?" He says, "Buddy, when interest rates are high is when to buy." I go, "Why is that?" He says, "Because everyone's going to, when interest rates are low, it boosts the price of your home and your cash flow is going to go up because all your stuff's going to get refinanced." Yep. So all my leases have a bump in them every year. And your mortgage payment, even though it makes sense right now at current, not owner occupied rates, is when you refinance at a lower rate, it's even going to get better and the home's going to appreciate.
Yep.
I'm telling you.
Man, that's super smart. And I think, it's an incredibly interesting business model. Yeah. And I think that for, especially for people in markets like mine, right? California, you can't do shit with 30 grand.
Negative.
Like
you're right.
You can't do anything with that, but you're telling me, okay, well, we can get, 10% cash on cash returns per year. Right. Of course that's not guaranteed, right? It's not a guarantee. But 10% cash on cash returns year over year for $30,000 investment. Cause to get involved in these syndication deals, you need at least 100 grand, if not more. Right. So you got
to be accredited maybe or what, right?
You have to be accredited. Right. So this is like a really interesting strategy, man. And I think that there's a lot of people that would benefit from associating themselves to this kind of strategy. Because I mean, at the end of the day, so many people, I don't know if you know this, Michael, but the average American investor has 85 to 90% of their investments tied up in an index fund or stock market. Right. So 85 to 90% of their net worth, outside of the primary residence is tied up into stocks and bonds. And it's like, it's crazy that, real estate is such a, I mean, we're biased.
Of course.
But to me, it's just such a better investment vehicle long term. And
your retirement account and your traditional IRA, you can't borrow money to buy stocks. Okay.
Correct.
In a regular margin account, I used to teach and train on the stock market, so I'm familiar with that industry. You can borrow 50% margin to buy Tesla or Microsoft or Google or whatever, right? We can borrow 75 to 80% of the purchase price. Okay. And I just view it, some people pound their chest on what's better or worse. I just think of it like this. When I retire, I want not a 100-legged table, but at least a 5 or 10-legged table, right? I wrote a book. It's on Amazon called Retire on Rent. I don't make a lot of money from that, but Amazon sends me checks. I have houses. I have this. I have that. I have, you know what I mean? I have got all these different things, and I just can't. The stock market is great for accumulation. It's not great for income. Okay. Mm-hmm. One more time. The stock market is great for accumulation, not great for income. Yep. So if you've got your $1 million and you're used to, I've got a friend of mine who makes $300,000 a year. They have over $1 million. They're in their 50s, over $1 million in the stock market. They make $300,000 a year. Okay. What's the rule when you pull it out of the market? 4%, right? Everyone knows that. So you pull 4% out of the market every year. Okay. So you got $1 million, you're going to pull your $40,000 out, and you're used to living on 300. What the heck? I mean, you're used to making $25,000 a month, and you're going to pull $40,000 out a year. So what happens if you pull out $300 a year out of your $1 million? Ain't gonna last very long.
And you will be broke very soon.
Right. So if you just have that insight enough, and a lot of people, by the way, you and I both know, a lot of people don't have 7 figures in their retirement accounts when they retire. So if you just think, hey, wait a second, I've got good credit, I can do this. Worst case scenario, I can make a little bit of money and sell it if it doesn't work. I'm not, and it's gotta start, man. In fact, I had a friend who had an investment. They went through a marital situation, and they're like, I'm just out of cash right now. Do I sell? And I say, no, but let me do some work for you. And I found out they had over $100,000 of equity in their house that they put a, $20,000, $30,000 down payment on. And I went to my investor friend. I said, just pull an equity line out, or a second. You can get there's a variety of ways to pull the equity out. Don't need to sell it. Yep. In fact, how about this? Pull the equity out, and the tenant's rent will pay for that equity loan, because the rent still covers your original mortgage and the equity loan, because the rent has doubled since they bought it. And so they paid off all their credit cards, put a $25,000 down payment on a car, and the tenant's going to pay the loan. Yeah, these are things that are fun to have when you have assets.
Yep.
And, and it's very safe feeling. I'm 51 years old, and I feel safe knowing that my money's in these things. And also, some people who are savvier, like yourself, who do these sexy things with money and real estate, whatever. I have kids, and my wife isn't very financially. Our conversations at her with her girlfriends aren't about these things. Let's just leave it at that, right? So if we leave the wife with all these kids and all this money, they're not going to know what to do with it. They're going to put it in index funds. Well, remember, I was kicking, let's just say I was making 300, using an example. If I was adding $25,000 a month to the checking account, honey, and I'm dead, and I leave you $1 million, or two, I need to have that monthly income for you. I'd rather leave that family with $15,000 a month in income off assets than $1 million, because what are they going to do with that? Pay off the house, pay a few cars, then what?
Right. And with a solution like yours, leaving a portfolio of properties that are being, basically, completely managed and overseen by a group like yours. I mean, it's really like owning, like an apartment complex with like an experienced property manager in there that kind of like runs the show. Yeah. So it really does feel like that. Michael, this has been great, man. Learned a lot. I think the audience certainly got a lot out of it too. And by the way, the link to Michael's book and all of the ways that you can get a hold of him are going to be in the show notes. So you feel free to go down there. You have an affiliate link for that book, bro? No, I'm just kidding. I'm joking.
Yeah, for the $14.
Yeah. My so I can get my $1 check.
There you go. Now, the most important thing you didn't ask, my friend, is what do I do for fun? And hands down, between you and me, I got you kicked. I am a hands down better pickleball player than you. I can tell you that.
I'm sure you are, dude.
For free. I'm one of those guys who, I play 4 or 5 times a week. I'm a 4 or 5 player. So if anyone, if you're a pickleball player, you get a discount on a house. All right.
Oh,
there you
shoot. Oh, wow. Oh, man. Better start picking up a racket or something.
That's right.
That's cool, man. Right. Awesome, Michael. Well, hey, as is tradition here at the Gould Mine, we're going to have you leave the audience with one final Gould nugget. Take it away.
Life is either an adventure or nothing. And I'm going to repeat what I said before, is that good judgment comes from experience and experience comes from bad judgment. So do not be afraid to fail. Fail forward fast.
Love it, man. I could not agree more. Michael, it's been a pleasure. And thanks for stopping by.
Absolutely.
All right, man.